So the Federal Reserve got this two-day meeting. It begins tomorrow. We're expecting the Fed to raise interest rates on Wednesday, quarter of a point. Mitch, big impact?
I think that's totally baked in, although there are, a handful of folks that are betting on the fact that they won't do it. But I would say the smart money is that we see it. The real question, and this is to you, Phil, what happens next year? Because this sort of massive sell-off, you said a bad couple of months, all started when words came out of Chairman Powell's mouth.
Exactly.
And the question is, and he has spoken, and it hasn't turned the market around. So it's really going to be actions that the market's looking for. And what are your thoughts on interest rates in next year?
Well, what's ironic is that I think Powell made the same sort of rookie mistake in October that Bernanke made with you years ago at that cocktail party. So he's, I think, attempted to walk that back at the meeting a couple of weeks ago. We'll get more of that this week. Now, the issue is the dot plots, not the rate hike. We're all sort of pricing in a rate hike here. You look at the last set of dot plots, and what the Fed was telling us was we're going to get one hike in December, 3 more hikes in 19, another hike in 2020. That'll take the funds rate up to about 3.5%. In our view, and I think the market's view generally, that was too much. And that would be enough to invert the yield curve and push the economy in a recession. So what we expect to see, what we hope to see at this week's meeting is the Board of Governors generally pulling their dot plots back in such that I think the Fed is going to skip March because of the imposition of the trade between the United States and China, as well as the Brexit deadline is coming up at the end of the month. Yeah. Maybe we get a quarter-point hike in June if the economy sort of bounces back a little bit, but I think that's it.
Yeah, increasingly people are thinking 1, 2 tops in terms of rate hikes next year, David.
And the conversation will surely turn to the reduction of the balance sheet, which I've argued is more important than even the short-term interest rate hikes, because, again, we don't know how this is going to play out, unwinding this unprecedented stimulus through the bond buying, where, the balance sheet is now below $4 trillion, $50 billion a month is rolling off. And I know Stephanie Pomboy, we give her so much credit, rightfully so, for everything she's been saying this year. And she emailed on Friday and said, I think that the surprise for 2019 isn't that they pause rate hikes, but that they pause on the quantitative tightening or pause on the reduction in the balance sheet.
Because that's a form of tightening.
Right. And I think that the conversation turns to that as well.
I think you're spot on, that if we were having this conversation a quarter or so ago, the conventional wisdom is that the Fed would reduce the balance sheet down to about the $2.5 trillion level, maybe by the end of 2020. I think that number ends up with a 3 handle at this point. And we're doing $50 billion a month now, as you mentioned. I think the Fed is going to cut that off higher. So I think maybe you end up with a $3 trillion balance sheet and 3% or lower Fed funds rate. That becomes the new neutral. Right. And I think the market gets some confidence.
Well, look at these expectations for the economy, Lee. A new Wall Street Journal NBC poll finds 33% of Americans think the economy will worsen in 2019. What does this tell you?
I'm not surprised. In fact, I would expect this number to be higher because everybody's now talking about the fact that it's got to slow down a little bit, that the expectations on growth are going to slow next year. We can only do so much.
How slow does it go, though?
Well, so we've got a 2.9% GDP estimate for this year. We think the first 2 quarters will be slower, but the back end of the year will be okay. We think we end the year at about 2.5%. So will it be slower? 19 over 18, absolutely.
What about 2020?
Well,
that's the year in debate, right? In terms of whether or not we're going to see like 1.9% or 2%.
In terms of the recession watch, we're comfortable that we're not looking at a recession until the 2021 or 2022 period. But you're absolutely right. There's not a lot we can point to right now that's going to give folks any confidence in 2020. And I think that's the question. All right, if 2019 is just slightly slower growth, what about 20? Does the economy roll over and die at that point?
Sounds like you're still buying stocks.
We are. We thought the market would pull back and find support at 2,600. We're basically there right now. So now the question is, what's the catalyst that's going to reverse that? And you've got this possible government shutdown later in the week. That's weighing on people. The China trade thing, Brexit. I mean, you've got a lot of things that are worrying investors right now. Yeah. But in terms of the fundamentals are still decent.
One thing I just want to point out, because the Santa Claus rally story is buried in the journal, but what's on the front page is the fact that the S&P this year, the total return, including dividends, is roughly flat because S&P 500 companies have paid out a record amount in dividends this year, $421 billion just through November. So watch those dividend payouts because, again, if the economy slows dramatically, if companies are getting pinched, they're going to cut those dividend payments. Those dividend payouts have given investors comfort and given the markets a little bit of ballast.
Yeah.
Maybe it would be worse if not for those dividends.
Well, probably the last thing they want to cut.
Right. Exactly.
Well, generally speaking, if a company is going to increase its dividend, it doesn't want to then turn around a quarter or two or a year later and then cut that. That generates confidence that management's got a sense of what their future looks like. What we're dealing with here is a situation that we've seen before in 1984 and 1994. A flat year, good corporate earnings, significant contraction in PE multiples, in this case 3 multiple points this year. The following year in each instance was a pretty strong year for the markets. And we're thinking that next year is probably going to be up 15 to 20%.
Wow.
We think it'll be a surprisingly good year in 2019 for stocks.
So S&P will be up 15 to 20%
Yes.
in 2019?
Correct.
Big call, Phil.
You write that down.
Thank you so much.
Thank
I will.
you.
I just did. We just wrote that down.
15 to 20% on the S&P 500 in 2019. Phil Orlando.
Merry Christmas.
Merry Christmas to
Thank
you.
you.
And thank you for what you're doing for autism. Autism
Thank
Speaks
you.
button right there on
Thank you very much.
on your collar.
Thank you.
Phil Orlando.